Quite clearly, I have been there and I have seen it with my own eyes. They have reached a state of development that is comparable with the West in the large cities. But very importantly is the demographics. All Northern Asia and Europe are moving to peak population. And that means less oil demand because your demand consumption peaks between 40 and 45 years old. And China is getting into that area.
Okay, and Frederic, same question to you.
Well, I guess what we've seen this year is a bit of the both. We've seen the combination of very poor economic growth in China and the very beginning of this energy transition. It's highly visible with the gasoline demand in China, which is not related specifically to growth, but much more to the EV penetration. As His Excellency made the point very clearly, it's also a desire from the Chinese authorities to move away from oil as soon as possible for many reasons, CO2 of course, but also pollution, which is a slightly different issue, and also the energy security. So if you combine this and look at the medium-term trend, we would expect Chinese demand growth to be weak. As a matter of fact, the Chinese economy is maturing, and as a result, it's less and less energy intensive or oil intensive. So this should be reflected into this post-oil trend, I would say.
Okay, thanks. And Jorge, just back to you, just because it's topical, and we had this big boost of China's stimulus measures. I mean, they've been consistent, but we had a big one in the last week, moving its stock market, moving other things. Is it going to translate in any way through to general consumer oil demand, do you think, or that's separate?
By definition, the stock markets have increased between 20 and 25% in China. And that means real money in the pockets of any stockholder. In addition, they have released measures to encourage second home demand, which they had been suppressing, the government had been suppressing for a number of years. We expect this to continue to fuel the economy, but to be more evident in Q1 and Q2. So what we have here is a bad Q4 coming up for the energy business. And even if China is maturing, we mustn't forget the globality of the market. So India is your next force coming up.
Okay, as His Excellency also referred to. Okay, let's go to our next survey question, please, for the gentleman. Question number 3, there you go. What's the most likely impact of Saudi Arabia increasing oil output as planned on December the 1st? Of course, we saw a couple of announcements they were referred to last night, also in the OPEC panel here at the awards, that Saudi Arabia is intent, as it has been saying for a while, that it will be adding some oil back onto the market. So what's the most likely impact of that, should it happen? And there's the 3 choices: prolonged period of lower oil prices, stabilization of prices, perhaps now that we know what's happening, that'll stabilize things, or increase in oil prices. Not sure how that could happen, but let's see. Other factors, perhaps. So let's have 10 seconds on the clock and have everybody voting, and we'll get your views on that. So the impact of Saudi adding barrels in December, and of course through next year as well. The answer will be behind you too. So we've got 43% for a prolonged period of lower prices, 53% stabilization. That's interesting. Jorge, stabilize? Will it stabilize prices?
I'm a simple economist. More supply equals lower prices. Less supply, higher prices. So here, if we're increasing supply, it means lower prices. Please focus on what happened last night. We had a major attack of Iran against Israel, and the prices really went up by $5. Otherwise, we would be in the 60s today. The situation currently is not healthy. And we really need to look at ourselves in the mirror and say, who is oversupplying crude at the moment? And some of the answers actually reside in this neighborhood.
Okay, Frederic, your response. Where did you vote, first of all?
Response A, I'm
A.
afraid. Yes.
Okay.
Well, I think we all know the outlook for next year. It's not very promising. Even if you take the most optimistic outlook for demand growth, which is around 1 million barrel per day plus, I would say. Non-OPEC supply alone can add 1.5. We're starting from a surplus this year, so there is clearly no room to increase supply further on top of non-OPEC supply. So if you build up the surplus, you're going to get stock built. At some point, the market will reflect that by switching from backwardation to contango, and that's opening the door for lower prices, I think.
Okay, I mean, on the second one, on 53%, Jorge, perhaps people feel confident about stability and perhaps, because, you know, if Saudi Arabia moves ahead with that, it's a signal to the rest of the group, particularly those who are overproducing at the moment, i.e. they will rein back, and that might give some confidence to the price and to the market. What about that?
No, I think if one were to take the bullish point of view, is the measures in China, the US Federal Reserve decreasing interest rates, and yes, this will create an impression of more money, and maybe inflation kicks in. If inflation kicks in, prices rise, but they are not relative to the rest. So what we need to focus on is, are the economies growing? And the economies globally right now are actually falling out of bed. China is not doing well, Germany is not doing well, France starts not to do well, so the signals are not very healthy.
Okay, the US has been doing okay, relatively speaking, but yeah, which has obviously helped matters this year, but that's beginning perhaps to shift. Let's have the next question. Okay, we're back to sort of the China question, but specifically seeing how that impacts producers. So how could weak demand growth in China impact national companies during an oil market share war? Okay, I mean, the word war is a big one. But again, the topic of market share is beginning to come back into conversations as the pressure on prices builds a little bit because of demand. So how could that weak demand, if indeed it continues, impact NOCs? Would it mean significant reduction in exports? Would it moderate reduction in exports, or have a moderate reduction, or no major impact? Frederic, I'm going to go to you to answer first. 58% have voted for the moderate
I'm the 58.
impact with the majority.
I voted for B. Yes, I would expect some only moderate reduction in exports. We do feel that Chinese runs should increase slightly next year, despite the moderate economic growth outlook. We would expect Chinese growth to be similar to this year, so slightly south of 5%. But we would expect not to see anymore some demand contraction, as we've seen probably in middle distillates, for example. So that would call for moderate reduction in crude export. However, in terms of market share war, we would not expect a big change in the market share in terms of export to China, much more like a freeze. Russia will still play a key role, and then the Middle East.
So there won't be any significant reduction in market share for anyone. The impact is magnified in the price. So if demand drops by 1%, you could have a 5% decrease in prices. And yes, Russia says one thing, but they always do the other, which is continue to produce and sell as much as they can. They need the money like anyone else.
Okay, thanks, Jorge. Let's have the next question, please. Okay. What's the most significant risk for national oil companies in an oil market share war? Again, we're looking at this sort of, as demand remains a little bit weak, how is that market share going to be impacted? And what's the most significant risk for NOCs? Is it loss of market share to non-OPEC producers? The US production is plateauing by some reports, or is it reduced profitability due to the lower prices? And will it even disrupt ongoing projects and investments of NOCs? So So which of those three is the most significant risk? %50 in the middle. Reduced profitability due to lower prices. Okay, Frederic, I'll go to you first on that. How did you vote?
I would agree with the 50%. Don't think that there will be a big market share redistribution among OPEC versus non-OPEC producers. It would be more like a global lower prices impacting profitability. Good to have in mind the fact that for the last few years, we had two main sources of supply which were very price sensitive. It was like OPEC on one side and the US shale on the other side. The US shale is less and less price sensitive actually because of two major drivers. One is consolidation. You see the majors entering the game, consolidating the US shale, making them less price sensitive. They're more used to be price takers. And the AI gain in productivity, which is also helping to reduce its sensitivity. So we're going to be left with only one major source of supply, which is really price sensitive in a sense.
Jorge, your response.
Yeah, there won't be any loss of market share to non-OPEC producers. In fact, there would be a gain of market share because some marginal projects would be put to bed and not see the light of the day. By definition, the profitability in the area will drop significantly, budgets will be hit, there would be more borrowing across the Middle East, and yes, at the margin, some projects would be also cut back. So my answer is actually B and C, which of course I couldn't do.
Yeah, it's a combo. Okay, well, the next question sort of does address non-OPEC production because it's the higher cost bracket, isn't it? So let's have that put up on the screen. What impact do you think a temporary drop in oil prices has on high cost production? I mean, you know, of course, admittedly, this region has an advantage when it comes to cost of production. So, Jorge, you seem to have a different opinion that non-OPEC will not be as impacted. Let's look at those options there. It only delays development, it halts production for a short period, partial scale back of projects, significant setbacks for future projects, or it kills it off completely. Okay, that's quite an even spread there in the middle. Frederic, how did you vote?
Voted for C, only a partial scale back of projects. Again, I was just making the point before, without knowing the question, that we have less and less producers being price sensitive outside OPEC, which is on purpose, right? Even the US is less, again, price sensitive. If you look at the break-even cost for the shale, the highest break-even is around $58 WTI. So that's quite some room before we test really the pain threshold. And even at that price, not sure that we're going to see most companies closing down some project. What you do is, yes, you may delay a bit the investment, partial scale back, but they're so fast to rebound that it can be only temporary.
I mean, Jorge, the US, I mean, Frederic is saying less sensitive, but, you know, we've been hearing the argument of they're not necessarily sensitive, but they're focusing on shareholder returns, etc. No hurry to really vamp up production necessarily all the time, and they want to just stay in good profit and shareholder returns. Tell me how you answered and also address the other non-OPEC producers, if you like, not just the US. What about Brazil? What about Guyana? Higher cost producers, and how will they be impacted?
Yes, my answer was D, but I was gravitating to C as well, because it's one of the two. If prices drop, there is an impact on production, but it's the longer-term projects. So Guyana and Brazil require a lot of money, or any other country that finds oil, and it's a function of interest rates and flat price, and the horizon that you have for the low price environment. At the moment, any grown-up company is looking at prices not above $75 and is looking at an interest rate that is in the 4% level, and of course they would pay 6 to 8%, and you need to work those mathematics. It's just mathematics. And the cost of some oil can assume those prices. 75 and $8, many projects will come in, but some will be hit.
Okay, and Frederic, just to wrap up for us, on that question of cost of money, obviously we've seen it begin to stabilize, perhaps come down to 4%, but what if the outlook is a 3 to 4% interest rate across the world? What impact would you say that's going to make on high-cost producers, if at all?
I'm not sure the interest rates are playing such a key role in the decision or even the timing of the project. I used to work for a big oil majors, and all the projects were assessed based on $40 assumptions to make the decision to FID the project. So you see, 40 is quite low, right? And again, it's on conventional oil project, the lead time are quite long. We're talking about 7 years on average, which means that some projects have been sanctioned 10 years ago. And now they're going to start next year, whatever the price. The investment is a sunk cost, so it's going to be price taker, whether it's 40, 50, 60, 100, doesn't make any difference in the decision to start or not the project. It's too late. You already invested billions of dollars into the project, right? So the short-term impact of interest rates, the oil price is really marginal.